Good morning, everyone. My name is Don Daniel, founder of Pill Method International, a better way to eliminate debt. And we've been doing this for 16 years, helping people to read and understand amortization schedules so you don't have to pay all of that interest. And I am welcoming every one of you here on Clubhouse today, and those of you that are watching us on YouTube, Facebook, Twitter, and LinkedIn as well. So if you want to see what we're talking about, folks, if you want to see what we're doing, then you can always go to your secondary device, your tablet or your computer, and type in ice10kvideos.com. And I'm going to put that in the chat, ice10k, and we're going to put ice10k videos with an S, videos. All right, ice10kvideos.com, and that will take you straight to our YouTube channel. Please go ahead and subscribe. Comment on, some of the videos that you see, and even like some of them. That helps get the information out, and our YouTube channel is growing. And thank you so much to everybody who is participating in that. And we've got our, we've got our engineer with us this morning, and Kirk Nugent. And listen, Kirk, anytime you want to jump in here, introduce yourself to the people, feel free to do so. We liked hearing from you. Kirk makes sure that everybody sees what's going on out there, and by using streaming technology so that we can get our message out there in live streaming, and then it stays up permanently. That content keeps teaching and teaching and teaching. So listen, I'm going to jump right in. If there are no questions, if there's a question out there, go ahead and raise your hand. Raise your hand now, come up to the stage, give your comment or question. If not, let's get into this thing right away on how you can dictate your own interest rate. Oops, that is the wrong one. Hold on. I got to get the right example here. Because when we have these, we want to make sure that our clients remain anonymous, and that one has the client's name on it. So let me go in here and get another one up. So in the meantime, we'll bring up invite to speak. Get somebody up here. All right, how you doing, Mom?
Hello there, I'm very well, thank you. I'm calling in from London. My question is...
Go ahead.
Is all of the information that you're sharing today, will it be applicable worldwide?
Yes, I have clients in London.
Okay.
Yes. So yes,
excellent.
Listen, the math that the bank uses, the amortization formula that the bank uses is worldwide. So the information that we use to disrupt that has to work there too. It's just math. We show you how to pay less interest on your loans. The only difference is we have to trade out the word. Pounds for dollars.
Yes, dollar and sterling. Yes, I understand that. Thank you very much. I'm looking forward to this.
Oh my goodness! Thank you for tapping in.
No problem.
Listen, stay on the stage, and if you have a question, please chime in with your question. Okay.
Thank you so much.
You're welcome. All right, Credit Goddess is here. All right, Credit Goddess, how are you this morning?
I'm great. How are you this morning?
Excellent.
Happy Sunday
to you. Happy Sunday to you. Why don't you go ahead and introduce yourself to the folks while I get my examples ready on the screen?
Absolutely. Hey, everyone. Happy Sunday. If you guys haven't already, go ahead and follow the club at the top, and also tap on Don's picture. Scroll down to where it says P.I.L.L Method. That's his club. So if you guys are new here, and just tuning in, definitely follow him at the club. Follow the moderators as well. My name is Rosalora Lewis, also known as Credit Goddess. I'm all things credit and the official credit expert for the P.I.L.L Method crew here. I'm a credit score improvement strategist. So not only do I help you repair, but I also help you rebuild. Those are the two main factors in improving your credit is building. So I do help my clients in building. I'm an educator at B Free University where I educate you on how to improve your credit. It's a journey. It's not a short temporary thing. It's actually a lifestyle. I'm also a credit score improvement. I'm sorry, the business credit consultant. So if any entrepreneurs, real estate investor, are you just starting up? I do have funding for you guys. So definitely tap in with me. I help you establish your credit so that way you can get funding for your business. So the number's in my bio. If you guys are interested in my service, send your name and email address there. A link will be presented to you where you need to book your consultation with me so we can get you started. Thank you, Don.
You're so welcome. You're so welcome. And we have Miss Donna here. Miss Donna, how are you doing? Could you tell us your entire name and where you're from and what you do, please?
My entire name. My name is Donna Anglin. I'm located in Canada. I'm a commercial loan broker, mortgage lender. Um, I operate on assisted living and independent living facilities here in Canada, and I'm always here to add value wherever possible. There's other things in my bio in terms of what I'm able to land and what else I do. Check my bio, and that's about it. This is Donna, and I'm done speaking.
All right. Thank you very much, Donna. Hey, listen, folks, we're going to get started with understanding what I mean by dictating your own interest rate. And what we're going to be referring to is what we call the effective interest rate. All right. The effective interest rate. And we're going to go in a little bit deeper to figure out what all of that means. But right now, I'm just going to show you the results of effective interest rate. So let me go ahead and get this ready for you. We've got, let me see, we got to put this on. There we go. And share screen. There we are. Boom. All right. So folks, so we're going to put this on the screen for you. And we have a total of $233,000 in debt, $233,000 in debt on the screen. And we have over here over $233,890.16. All right. And the average rate on this debt is 4.25%. And that's what it averages out to be. We have $7,000 coming in as far as this client has in income. And the monthly debt payments is only about $1,380 a month. All right. And it's going to, and they have about $1,700 in discretionary, which means they run the rest of their monthly expenses at $4,115.85. Now, that number also includes their lifestyle budget. And what do we mean by lifestyle budget? Lifestyle budget is how much money do you want to spend on your family to create a lifestyle, to create fun for the family, memories for the family, opportunities for the family outside of just paying bills. Okay. It's not just about just paying bills. It's about doing other things that make life worth living. And that is called what we call your lifestyle budget. And that goes into the system. All right. And then after that, then you pay your bills. And then we have what's left over. All right. Now, here's what we're talking about. I need you to see what we have here on. I've got line 1 here, line 2, and line 3. We're going to take a look at line 3 first, which is the projected payoff. The projected payoff is 29 and a half years. 29 and a half years. We're going to go up from that to total interest payments. The amount of interest that the bank wants on this interest, on this principal, is $176,825 if you're making your monthly payments on time on this debt. If you make your monthly payments on time on the debt, you will pay the bank $176,825 in interest on $233,000 $100,000 worth of debt. And so, folks, I'm trying to tell you right now, that is not 4.25%. Okay. So here's what we're talking about. Anytime you have 4% interest, the bank wants at least 71% of what you borrowed in the form of interest. 4%, when you amortize it, turns into 71% over the life of the loan for 30 years. 71% of the money you make, okay, of the money that you borrowed. That is interest. You know what? Interest is nothing more than rent on your money. You go from renting an apartment or renting a house to renting money your entire life. So the bank wants us to rent money for as much as they can get us to pay, for as long as they can get us to pay it. Now, am I anti-bank? Absolutely not. Actually, I love the bank because they have a resource I need. The resource that I need, they have money that I can leverage. Now, why do I like the bank? Even though when they charge 4%, we would end up paying 71% over 30 years. It's because I don't keep loans for 30 years. Because with understanding interest cancellation, you can pay off all of your debt in an average of 7 to 9 years, 7 to 9 years by using interest cancellation techniques, and you can still live well. Remember, this family is putting into their budget lifestyle spending. Wow. Even with lifestyle spending, we can still get out of debt cheaper and faster. Watch what's going on here. And I want to show you what I mean. All right. So here's the amount of interest that the bank wants, $176,825. Here's how much interest this family's actually going to pay, $35,349. The bank wants $176,000. I'm going to use their current budget. They don't have to make more money. We're just going to show them how to disrupt the bank's timing, because it's all about timing that creates interest cost. If you do it according to the bank's timing, you will pay more interest according to the bank's timing. But if you can disrupt their timing, then you can pay a lot less interest. If there are people out here, now I'm just going over the basics, but if there are people actually out here that want to know exactly how to disrupt the bank's timing on how interest is being charged, put a number 1 in the chat if you want to see it, because I'll go through the numbers after this example. If you want to see the numbers on how to disrupt the bank's timing so you could pay less interest, put a number 1 in the chat. All right. Either online. All right. We got Lojo. Okay. Okay. Barclay. Okay. So they want to see the numbers. You want to see the numbers. All right. I know it's not enough to just see the results. Okay. And on Boykin online, they want to see how it's done. Okay. They want to see how it's done. So we're going to get into a little bit about the how in a minute. So let's just go over the what can happen here. So if this family can pay $176,000 in interest, if the bank wants $176,000, they're going to end up paying $35,349. That means it's $141,000 worth of interest savings. So here's what we mean by effective interest rate. Okay, if the bank wants $176,000 in interest at 4.25%, and you end up paying $35,000 in interest instead, what interest rate would you have to have in the beginning? What interest rate would you have to have from the bank in order to pay $35,000 interest on this loan? Here it is. I need you to see right under the 35,000. I know that it might be a little small. Let me see if I can make it a little bigger so you can see it better. Okay. All right. That's a little bit bigger. So watch this. You would need an interest rate of 0.96% to pay this little interest on a 30-year loan. You would have to have an interest rate less than 1%. Folks, we create this for you. We have a computer program that does all of this. It says, if you move this much money in this month on this day of the month and attack this loan in this way with your current budget, you could be out of debt, look below this, in 6.5 years instead of 29.5 years, saving 23 years because you're paying only $35,000 in interest, which means you would have to have an effective interest rate of 0.96% to accomplish this if you received it from the bank. I don't care what the interest rate is. I don't care what the interest rate is. All I care about is how much interest I'm actually going to pay. All right. So I think we have some. All right. I have some more people. Listen, Donna, if you could keep an eye on things for me, because Credit Goddess, and see if we can get some more people up on the stage. I'm
doing that, Don.
Thank you. And if you
chat. Also, yeah, thank you.
If you see some questions, go ahead and chime in too.
Okay, so we had Rose actually answered one more. I think she's on stage. Her question, she was asking if it is applicable worldwide and if they are videos to watch. And we did respond to her in the chat. But for other people who are not looking in the chat, that was a question that she asked.
Great.
Sarah is also asking, is that possible?
Most definitely. We're going to get into the numbers. Just a little bit, but I wanted to show you this, what our results are. So every client that we have, we give these results. Okay. You can actually plug in your numbers by getting a savings and earnings report. So if you go to the top of the room, you will see our my 10K card, which is ice10k.com. And by clicking on that, you will by going to the link, you will see that on top of getting my book, you can get a savings and earnings report where it says step two, get a savings and earnings report. Now, here's the thing. We have a lot of people who generate these savings and earnings reports prior to becoming a client. You can see everything that you need to see. There's a gentleman out there that some of you may know. They got a savings and earnings report, okay, and decided to use the P.I.L.L method to pay off his mortgage in about 4 years. Now, after we hear from this person that some of you probably know, after we hear from them, then I'm going to get into the numbers as to how all of this can work. But if you want to know how you can get a savings and earnings report, how you can know the month, day, and year you can be debt free, we're going to hear about a little bit about that as soon as we hear from Dr. Eric Thomas. That's right. ET is in the house. Let's hear from ET right about now.
Listen to me, y'all. But one of his mentees took us through one of their programs, and I paid off my mortgage. But guess what happened? My marriage went to a whole nother level. And you know why? Because my wife is a security freak. And even when I blew up, my wife would be like, oh, you blew up, but how long is you gonna keep making this kind of money? I was like, I don't know, forever. She's like, you sure? Because I'm gonna keep my license as a nurse just in case you don't. So when I paid the house off, my boy was like, you ain't gotta do that, you can do this. But when I paid the house off using that program, it took the stress level all the way down for my wife because we no longer had a mortgage. Does that make sense? That thing that was coming every month, that was getting on her nerves, we didn't have that no more. And so she was at rest.
All right, ladies and gentlemen, you heard that from Dr. Eric Thomas, E.T., the hip hop preacher. And in fact, and later on in the show, we're going to be playing our brand new television commercial that we have on here that I'm playing in this local market so that you can actually see that. So folks, here's what we're talking about. Here's what he's saying is that he paid off his mortgage in 4 years, and not just the mortgage, but all of his debt by going to ice10k.com ice10k.com, you can click on Get a Savings and Earnings Report. By clicking on Getting a Savings and Earnings Report, you can put in all of your financial data. Now, here's what we want you to know. You can, by going through this form, make sure you read all of the instructions, because there's an instruction that says, once we confirm your telephone number, your cell phone number, we're going to send you a code as a text message. Wait for the text message before you go further. Once you receive that text message with the code, then take the code and put that back into the website, and it'll let you go even further. Okay. And then click on Yes, I want to save. Once you get all of that done, it'll let you into the form, fill out the form, and then someone from my company will get a hold of you, and then we'll set up a consultation for you so that you can know the month, day, and year you can be debt free and how much interest you can save. And we do this worldwide. Sometimes this thing, this for in some countries, confirming the telephone number does not work. If that is the case, we have other numbers. Call the office, or send us a text, or and you can use WhatsApp, get a hold of us, and we'll get your information another way if you are an international client and this system doesn't work for you. So get a hold of us, and we'll still produce a savings and earnings report for you so that you can know the month, day, and year you will be debt free. Let's get back to our examples here. And so somebody said, so Don, I can see that you said that we can save that kind of money. I can see that. I can see that you say you can go from 29 years, all right, to 6.5 years. But how does that work with your current budget? And whether it's pounds or whether it's dollars or whether it's yen, it doesn't really matter. Okay, so I got Kirk 10K here. Kirk, listen, man. Before I go into the next session, can you come in and talk to the folks and tell them how important it is to be able to get their information out here live stream? I mean, how valuable is that? Can you talk to the folks?
Hey Don, how you doing, man?
Excellent, man. Good to see you, man.
I totally forgot to put my headphones in.
Listen, man. Listen, when Kurt is on here all the time, you see his studio. I mean, when you see his studio, mine looks like Legos. Compared to Kirk's studio. I saw Kurt online one time and he was doing his thing. And I said, Kurt, I'd like to have a studio as well. Can you set me up? And I said, just tell me what to order. So he sent me a list of stuff. I ordered the stuff, and then he came into my office and set up my studio for me. And now listen, Kurt, this is show number 121 you've done with me? 121 shows.
That's amazing, man.
Of course. Tell us why this is important so I can get into these numbers for the folks.
Oh, yeah, absolutely, man. Listen, first of all, this is Don's, as he said, 121st show. Here's one of the key ingredients to being successful at putting your message out there is consistency. People know, like I think it was Coach Coffee Brown came in the other day and she's like, I missed you on Mondays because he's been so consistent that when we dropped that day, she just knew that was the time frame. But consistency is so critical. One of the things I love to do with folks is let them know that your live stream is your digital storefront. I'm going to repeat that one more time for the people in the back that aren't listening. They're just kind of waking up. They've probably heard like the last thing that I said. Your live stream is your digital storefront. Your digital storefront. This is where you put your wares out, the products, services, your skill sets, all the things that you have to offer the world. You put them in your storefront. You want people to see them as they're walking by. You want people to see them as they're doing their regular everyday thing on social media. You want people to see you in your sphere of influence and expertise and excellence. Your live stream is your digital storefront, and allows people to see you. It allows people to know what you have to offer. And if they make a mental check, like, oh, okay, if I ever need some financial anything, I'm going to come back to this room. I'm going to come back to this space. I'm going to come back to this live show, because Don is that person. And I've seen him do it maybe in, passing. Some people watch just kind of as they're doing other things. Some people are engaged listeners and watchers. And some people are signing up and they're having transformational experiences with Don and his and the P.I.L.L method. But that's what this thing is all about. And so if you just take Don and the P.I.L.L method out of that equation and just place your name and your product or your service, you could be doing the exact same thing and letting people know about what it is you have to offer. Don't close your digital storefront. Make sure it's open. the amount of people that pass through Facebook, YouTube, LinkedIn, Twitter, Instagram, TikTok on a day-to-day basis necessitates that businesses, brands, coaches, consultants, authors should be in these spaces sharing what they have to offer with the world. And that's what I like to help people do, get people started. As Don talked about, helping him get his studio set up, of course, getting the live stream set up, all of the graphics, and producing the show. The stuff that you see on screen, that's the stuff that we get a chance to work with him to do. Don't always get to come on camera, but I was in the studio already today, so I decided, let me jump on camera with Don and see what we got going. Listen, folks, you're in for a treat. Make sure you're sharing, make sure you're liking, make sure you have already clicked the subscribe button. Make sure you are followed the club on Clubhouse. Be sure to come back to these spaces and don't just keep it to yourself. You're going to learn some things here that absolutely will change the trajectory of your financial outlook. Okay. Because why am I saying that? Is because not only am I working with Don to produce this show, but my family and I have our own opportunity cost calculator. We have our own account with the P.I.L.L method, and we know exactly the day, month, and year that we will be debt free. In fact, Don, we just paid off a car, man. So we got to come back and get some things redone or recalibrated in our P.I.L.L method account, because we're going to reallocate those funds. We might get some.
You paid off a car early?
Yeah, Doc. Yes, we did, Doc.
Listen, man. Listen, man. You got to go. You got to do a review, man. Go up to Facebook
absolutely.
Do a review for us, man.
Yeah, man, I'm handing it back over to you, Don. So I appreciate you guys I appreciate you always making sure that I'm in here, always making sure I have an opportunity to share and let people know what we do and what we offer. And again, if you guys ever want to tap in with me, it's kirk10klive.com. That's my digital business card from 10K Cards. Haven't seen or heard from him in a while, man. I got to message him as well. But that's my business card, and definitely you guys are in the right place. If you want to learn how to take care of your finances, pay off whatever debt you have, as long as you've got a loan. If you want to learn how to do that, you're in the right space, right place, and Don is going to take care of it. So Don, back to you, and let's see this example.
All right, good. So I got Tiante in the house. Good morning to you, madam, and we appreciate you so much. You and your husband providing this space for us here in the Mortgage Syndicate Club. Nice. So you're here with pay off mortgages in 7 years, and not just paying off your mortgages, but all of your debt. Let's go back to our original program, our original example. Let's put that back up on the screen. I'm going to go over that very quickly, and then we're going to jump into showing you the numbers as to how that can work. So we have about $234,000 in debt. Rounded. So we're going to round it off in our example at about 4.25. All right. And here's what's going on. We're using the current budget from this family, and knowing that the bank wants $176,825 in interest on this debt, and they want the family to pay it off over 29 and a half years. With the P.I.L.L method, they're only going to pay $35,349 and pay it off in 6.5 years using their current budget. And which means that their interest rate, remember, this is all about how to dictate your own interest rate. Their interest rate that they would have to have gotten from the bank to accomplish this purpose without the P.I.L.L method, they would have needed an interest rate of 0.96%. Wow. 0.96%. So we don't care what the interest rate is. We care about what your interest cost is and how we mitigate that. And so that means it's $141,000 interest savings, and that is an 80% reduction on interest cost. Listen, folks, what we're doing here for this family is like giving them a coupon for 80% off on borrowing their money, and they're going to the bank and cashing it in. How would you like to be able to do that? So we had some people who wanted to see some of these numbers. And so we're going to change screens here. We're going to put some of these numbers up on the screen. I want to know if, we have you see this $234,000 at 4.25%. And if you want to see how we go through these numbers, put some number ones in the chat. Put some number ones in the chat, and I will teach you how to read an amortization schedule and give you the basics of how all of this works. Now, I want to be able to be ultimately clear. This is not financial advice. I am not advising you on how to optimally save money. We're just teaching you how the bank makes its money and how we can disrupt their timing. I'm not giving advice as to what to do 1, 2, 3, 4. So here's what I mean. It is impossible to give you good advice that would apply to everyone. This is an individual situation. I'm just giving advice in general. I'm just teaching in general how interest cancellation works. You can take this information and save money. But if you want to save the maximum amount of money for you and your family, you want an opportunity cost calculator to do all of the math for you and to tell you how much money to move, when to move it, which loan to attack, with exact amounts of money, and which month to do it in, which day of the month to do it on, so that you can save the maximum amount of interest per dollar applied. So let's go over the math right now. Let's go over the math. We have $234,000, okay? $234,000 at 4.25%, 360 months, that's 30 years. The payment on that is $1,151.14. So folks, the payment is well within reason. The payment is well within reason. And that's what we're looking at. We look at interest rate and we look at payment, okay? But we don't look at interest costs. So let's scroll down to the summary. I need you to see this now. $234,000 in principal borrowed, but look at this line here, total interest paid on the left side of the screen. Total interest paid on the left side of the screen, $180,000. If you are online, if you're in Clubhouse and you want to see this, please go to ice10kvideos.com. That's ice, the number 10, the letter K, videos.com, and you're able to see this on your computer or your tablet. You can see these numbers, okay? So folks, let's go ahead and type that in the chat for people who want to come in and see what's going on. All right, so here's what we're looking at. $180,000 in interest that the bank wants on $234,000. Here's my first question. Folks, is $180,410.40, is that 4.25% of $234,000? Answer is no, absolutely not. So if we go over here, let's go over here to the right side of the screen, and we see that total interest paid as a percentage of principal is 77%. Do you know, Kirk, when people first hear about what we're talking about, you know what they say. If it sounds too good to be true, it usually is, all right? Usually is, but in this case, it's not. And so they're quite incredulous about what we're talking about. Mm-hmm. It's hard for them to believe that we can cut this much interest out. Do you know what is not hard to believe? That they have a 4% loan where the bank really wants over 70% of their income, over 70% paid back on their interest. It says 4.25. What really happens is paying back 77%. Folks don't find that hard to believe until we point it out. They say, I never knew that. So if math can take 4% to 77%, why can't math take 77% down to less than 1%?
There it is.
Come on. It's just math, folks. It's not magic. So here's what I need you to see. Let's go down to payment number 1. And I wish I had somebody on stage, somebody from the audience that is watching this that can go over this with me. And I wonder if Mon is actually seeing the example. Yeah, if you are, please let me know. All right. So here's what we've got, folks. On the very first payment, only $322.39 goes to principal, $828.75 goes to interest. $828.75 goes to interest. But the next month it gets better. $827. And then $826. Can you imagine making a payment on something of $1,151.14, and out of that money, over $800 goes to interest while you're struggling to pay off this loan with only $300 payments out of your $1,100? Who wants to do that? So let me show you what you need to understand how amortization actually works. You're charged interest on the principal balance. So whatever the principal balance is, the bank is going to charge you interest each month on that based on how they do the math. So if you wait every month to make a payment, that's the bank's timing. You got to give them $800 on this loan. Okay. So which means is if you could give them money at a different time, you may not have to pay the $800. Let me show you what I mean. So on payment number 1, let's say it's in January, we give the bank our payment, $322.39 goes to principal. We subtract that from what we owe. We're left out of our $234,000. We're left with $233,677.61. The bank does its math on this. We wait an entire month and it tells us how much interest we owe on line 2. Now remember, whatever line you're on, look to the next line to see how much interest the bank wants you to pay. Always look to the next line. You don't even have to do the math. Just look to the next line to answer these questions. So with $233,677.61 that we owe, the interest for month 2 is $827.61. $827.61, which means that's a little less interest, but a little more money goes to principal, $323.53. Now, here is the weakness in the bank's system. Because they chose a system that makes so much money for them, there is a weakness in the system. And the weakness is you can never know how they do it. Because once you know how it's done, you can save at the same rate they're charging you. What? You can save at the same rate they are charging you. Watch this. So let's say we make that first mortgage payment in January. We make that first payment in January. And once you make that payment on January, guess what? We can see February's principal payment of $323.53. $353. Okay. All right. $323.53. I see Frank Morales in there. Hey, Frank, how you doing, sir? Good to see you here. Frank, if you want to come up to the stage, just, you have to just raise your hand. The folks will bring you up. Okay. Because we'd love to have, I see Frank every Sunday morning in Real Estate Wealth Chat. And he is a real estate investor par excellence. Okay. And he knows his stuff. All right. So folks, watch. So we're making our January payment, right? And now we're looking at February's principal payment of $323.53. Guess what? We don't have to wait till February to give the bank $323.53. In fact, we don't have to wait till February to put any amount of money on our mortgage or student loan or credit card. I'm just picking this number out because it's easy. It's right here in front of me. $323.53. What if we gave that to the bank early? I mean, what if we gave that to the bank in January as well? Did you know that all of that would have to go to principal? $323.53 would go to principal in January. We're paid down to line 2, $233,354.08. We're paid down to line 2 in January, which means our very next payment, remember, wherever we are at the end of the month, always look to the next line to see where we go next. So if you're on line 2 in January, that means your next mortgage payment for February is on line 3 of the schedule, where $324 or pounds or yen or whatever it is, 324.68 would go to principal, and $826.46 would go to interest. That would be your next payment. What just happened? We just got rid of line 2. Remember, this is a 360-month payment opportunity here, 360 months. We just turned it into 359 monthly payments by giving the bank $323.53 early. And the interest on line 2, $827.61 in interest, we do not have to pay. We don't have to pay that now. We just saved $827.61 by giving the bank that money early. And number 2 line is gone. And we are now on mortgage payment number 3 on the amortization schedule. And we just saved a bunch of money. So it is that easy to get rid of interest and payments when you prepay. You see, the problem is everybody knows that they can prepay. Everybody knows that, but they don't know how much interest they're saving when they do prepay. You want to know how much interest you're saving so that that amount of money can be optimized. You want to pay the right amount for you so that you can save the maximum amount of interest per dollar. Let's just say you could save $4 for every dollar you apply to principal. Let's say you could save $4 for every dollar. That would be pretty good return on your money. But by paying the wrong amount at the wrong time, you could go from $4 for every dollar to $3.50. So if you could save $4 for every dollar, why would you ever want to save $3.50 per dollar if you could save more per dollar? You see, we will accept anything we can save because we're not taught how to measure our savings. You can't optimize what you can't measure, and we have been taught not to measure our interest savings. In fact, the bank has never sent you a receipt that says, here's how much interest you saved for giving us this extra money. Okay? You've never received a receipt from the bank that says, here's how much interest you saved. And you know what else? We have never even bothered to ask. Banking is the only place I know of that we give the bank all kinds of money, but they don't have to tell us the results of giving them that money so that we can put together a plan so that we can make our dollar go farther. Whenever you pay something, you want to get the biggest bang for your buck. Is that right? Is that right? So folks, if that's true, can you put a number 2 in the chat? If you want to get the most out of your money, whenever you're doing anything, do you want to get the most out of your money? Put a number 2 in the chat. Okay. There you go. There you go. So that's what we're talking about today, folks. So go ahead and share. Go ahead and share this room one more time. Go ahead and share it. And so that you can see what we're talking about. We have some new people in the room. Now we're up to 44 people. I got 9 shares. Can we get up to 15 shares? Can I get up to 15 shares? We got 17 people online. We have 44 people in the room. So if I can get up to 15 shares, or we're up to 10, keep going, folks, keep going. We're up to, can we get 15? Oh, we got more people online. So if you want to see what we're doing, go ahead and click. Go ahead and click on, or I'm sorry, and type in ice10kvideos.com, ice10kvideos.com. That would take you straight to our YouTube channel. Go ahead and subscribe, please. And like the videos there, and you'll see our live presentation. You can actually see what we're doing live right here, right now. Folks, is there anyone out there that is getting ready to get a mortgage, or has a mortgage, or thinking about refining to a lower interest rate? Because some of the things that we're talking about here, where you can dictate your own interest rate without refinancing, is what we're talking about today. Do you know, I'm listening to the national news, Kirk. I'm listening to the national news. Guess what I found out from listening to the news? They're giving out financial advice because of the interest rate hikes. Okay, giving out financial advice. And one of the things that they're giving out is if you can wait for the interest rates to go down, then purchase either your car or your house. Okay? All right. And I'm saying, don't do that. Don't do that. Number one, I'm here to tell you, and you can clip this, you can repeat this after me. I'm telling you right now, the higher interest rates are the better ones. If you want to save money, if you want to gain equity faster, if you can afford the payment, take the higher interest rates that they're giving out now. I will show you how you can make the interest do anything that you want it to do. In fact, I'm going to go into my next example is showing a real estate investor that has an 18% interest rate and how they're going to beat that interest rate up. They're going to take the bank to the cleaners on an 18% interest rate. Listen.
Before you go, Don.
Yes.
Before you go, there are 2 people in the chat.
Yes.
One is closing this month, and the other person is 2 people, because it's August. So closing this month, and the other person said closing end of August. So that's Lolita, and that's Jamie Mela. If I pronounce your name, if I mispronounce, sorry for that. But there are 2 people in the chat. If they want to come up on stage and just give a chat to you, but they are closing at the end of the month, and they really need this.
Wow. So bring them up if they're closing, because this is valuable information that you need. Okay. You're not going to get this anywhere else. Your lender is not going to teach you this. Your real estate agent isn't going to teach you this. Do you know why? It is not because they're withholding the information. It's because to get a license to become a real estate agent, it is not required for a real estate agent to understand how an amortization schedule works and how to defeat it. They can give you some advice like biweekly payments or round up your payments or whatever, those things. But the most they can save you with the information that they're taught is taking a 30-year loan and turning it into a 23-year loan. They can save you 7 years if you follow their advice. What we're talking about, folks, is paying off all of your debt, not just your mortgage, your mortgage, your student loans, your credit cards, and your car loans in an average of 7 years. Not saving you 7, paying off in 7. That's what we're talking about. So when you understand how all of this works, okay, so if you can come to the stage, all right, so we have some folks on the stage right now. We have Miss Lolita. Miss Lolita, how are you this morning?
I'm doing well. Thank you so much.
So
I am. Go ahead.
talk to us this morning. What's going on with you?
We are purchasing a home at the end of the month. And so I'm, constantly listening to all this great information you guys share on Clubhouse. And so you asked, is anybody in that current situation? And that's us.
Miss Olita, as you're looking at that information, you're closing. Have they sent you out your you said at the end of the month. So they usually send out your disclosures 3 days before closing. So you haven't gotten that yet. But have you done any looking into the amount of interest you're going to have to pay on your loan? Have you looked at that at all?
It looks like it's at I think it's 5.5. I think it's 5.5%.
5.5% interest. But do you know how much interest that's going to translate to? How much interest you're going to have to pay?
No.
Would you like to know?
Yes, I would.
Okay. And would you also, after we wake you up from fainting, would you also like to know what to do about it?
Absolutely, yes.
Are you watching what we're doing online right now?
I had to toggle back and forth because I'm only on one phone. I'm gonna pull it up on my husband's phone.
Or you can, you can pull up on your phone or on your calculator. I'm sorry, your computer. Okay. You can look at it on your computer as well. But we want to show you your numbers. So go to ice10kvideos.com, ice10kvideos.com, so you can see us on YouTube. And go ahead and subscribe to the channel because we're growing. We're growing on YouTube. All right.
Yes, I have subscribed already. I just liked the video already.
Miss Lolita, look at you. Look at you. All right. So let's go ahead and we're going to put your information in about your new loan in here. Okay. And let me tell you, Miss Lolita, when you found out that your interest rate was 5.5, how did that make you feel?
Not great.
Let me tell you, I love your 5.5.
Yes, sir.
I absolutely love it. Okay?
Yes, sir.
So I'm going to tell you why. Here. So tell me, what is the amount of money you're going to be borrowing?
It'll be $386.
386,000. Oh, on the other device, or you want to turn down the volume. 386,000 at 5.5. And folks, let me tell you, you need to follow Miss Lolita, give her a hand clap, give her a follow, give us a digital currency, because this takes a lot of courage to put your information out here. Okay. 386,000 at 5.5. Here is just the principal and interest payment. This does not include taxes and insurance. Your payment is going to be $2,191.67, Miss Lolita. Okay. That's just the principal and interest. Okay.
Okay.
All right. Now, let's scroll down here and take a look at 386,000 at 5%. The bank wants total interest paid. This is the last line on the left side. How much interest does the bank want from you total over 30 years?
$403,001.20.
Miss Lolita, is that more in interest than you're borrowing in principal?
Yes, it is.
Does that look like 5.5% to you?
No.
It does not. So if you borrow 386,000 and you pay back 386,000 in interest, what is the real interest rate here?
100%.
Come on, sister. Listen, I don't need to do math. I don't need to know math to know that. Listen, If you look over to the right, we've figured it all out for you. How much is it exactly?
104.404%.
Listen, I think that's even more than payday loans.
Right.
Yes. Do you want to pay all that interest?
No.
All right. Let me show you something here. All right. How you can control your interest rate. And for a lot of my clients, by the time that we figure out how much interest they're going to pay, we take that 5.5%. We take that down to like 1% or less. How would you like that?
I would love that.
How would you like that without having to refinance?
That would be amazing.
Ooh, how would you like to do that and not affect your lifestyle?
I didn't even know the word to use to describe that.
Oh, okay. Okay. You mean, lifestyle is, you pay your bills and everything, and then you still have a little bit of money to go shopping with.
Oh, yeah.
Okay. And vacations.
Yes.
Okay. Getting your hair done and nails and stuff.
Fixing up the backyard.
Fixing up the backyard. Listen, sister, we don't want, there you go. We don't want to touch any of that money. Yeah. You'll still be able to do all the things that you would like to do and still manage to pay a lot less interest. So we can treat this like you are paying 1% or less. You want to know how to do that, right?
Yes, sir.
All right. So now we're going to scroll down to payment number 1 because I'm going to need your help on this. Okay. So, all right. So I'm at payment number 1, and payment number 1, we're paying $422.50 on principal out of that money. Out of all the money you're going to be paying, only $422.50 goes to principal. How much goes to interest?
$1,769.17.
How does that make you feel?
Terrible.
Okay. Now, here's what I need you to know. And you can write this down. And folks, you can clip it. Interest payments you skip don't matter. Miss Lolita, will you repeat that after me? Interest payments you skip.
Interest payments you skip don't matter.
Don't matter. Okay. So they can put all the interest up there they want, can't they?
Yes, they can.
All right. Let me ask you a question. So if you had a brand new credit card, and it was 7% interest, okay? And a brand new credit card, and you charged that thing up by $2,000, but you paid it all off next month. How much interest would you pay if the interest rate was 7%?
0.
Okay. What if it was 15%?
0.
What if it was 25%?
0.
50%?
0.
It doesn't matter how much interest they want, does it?
Not at all.
It's how much interest you end up paying that matters, correct?
Yes.
Ooh, does it sound a little better now?
Yes.
All right, watch this. So if we make that very first payment of your mortgage, okay? And let's say we make that payment in January. February's principal payment is how much money?
The $424.44.
Do you have to wait till the next month to give the bank that $424?
No.
If you had it, could you give it to them in
Yes.
January? See, now here's the key. I'm talking about after you guys you're gonna build in a budget to have some fun. I mean, to like date night. Do you how large is your family, may I ask?
It's just my husband and myself.
Okay, so we're talking about
we're newly grandparents though, so we'd love to spoil that little one.
Ooh, there you go. Okay, girl or boy?
Girl.
Come on now, watch out. Go listen. I feel sorry for you when Grandpa gets a hold of the little girl. Lord have mercy. You're gonna need some money.
Right, exactly.
Okay. So here's what we're talking about, folks. After we spoil the grandchild, okay? Then after we have some after date night, after vacations, after we've had some fun, that's when we start paying bills. Ooh. So we're going to put lifestyle first. Lifestyle is first, and then we're going to do what? We're making sure that we pay the bills. We're going to make sure that we pay at least minimum payments on the loans, right? Got to do that. We're going to continue to put money away for savings. That's number 2. Okay. We're still going to make sure that we pay the rest of the bills, electricity, got to buy food, got to do all these other things.
Yes.
Okay. And so what else is there? So we're going to have some fun. We're going to pay we're going to pay we're going to put money away for savings. That's number 2. We're going to make minimum payments on the loans. That's number 3. All right. And then we're going to pay the rest of the bills. Boom. That's it. That's all 4. That's everything. Okay. So that means there could be some money left over.
Okay.
What do we do with that? We're going to show you how to optimize what's left over. Okay, so let's say we have at least $424.44 left over. Could we give that to the bank in January as well?
Yes.
If we did, the bank would have to subtract that from what we owe in January, and we're paid down to $385,153.60. We're on line 2 already. Which means our next mortgage payment for February is on what line of this schedule?
3.
Line 3. Now, has anybody ever pointed that out to you before?
No.
So what just happened? We just got rid of line 2. We had 360 payments. Now we only have 359 monthly payments because we gave the bank $424.44 that they were expecting next month. We decided to give it to them this month instead. What happened? So we got rid of line 2 with just $424. What happened to the $1,767.23 in interest the bank was looking for on line 2? What happened to that?
Because I'm listening to you, it's gone.
It's gone. Isn't that fantastic?
I never would have imagined, but it's gone now.
Interest payments you skip don't matter.
All right.
All right. So listen. If we have some more people that wants to come up, please bring them up. And so now, what if we did this? We make our mortgage payment in January, and we take a look at the next 3 principal payments on line 2, 3, and 4. Okay. We give the bank a little over $1,200. All right. Early. Look how much interest we save on line 2, 3, and 4. We save all of that money. Isn't that fantastic?
Yes, sir. Yes, sir.
Wow. Awesome. Okay, so we saved all of that money. All right, we saved all of that money, and then by saving all of that money, guess what? We're acquiring that equity much cheaper. I need you to take a look at cumulative principal here. That's column 3 and column 4. Look at that. Now I'm going to show you why. I love this 5.5 interest rate better than the 2.99% interest rate you just missed just a few weeks ago. All right. So at the end of 1 year, the bank wants you to pay this loan down by how much money in 12 months? Cumulative principal, how much?
$5,199.82.
And how much interest do they want you to pay in 1 year?
$21,100.22.
Do you think they want you paying attention to the $21,000?
Not at all.
Not at all. They just said, listen, we're going to give you a payment, keep making the payment and feel good about it, right?
Yeah.
Just be happy we got you the keys.
That's correct. Yeah.
Who do I hear? Miss Lolita, who's that laughing in the background with you?
My husband.
Just be happy you got the keys. So, Miss Lolita, may I have your husband's name too?
Barry.
Barry. How you doing, Barry?
I'm all right. How about yourself?
I'm doing well, man. Listen, I want to thank you, both of you, for being on here today. But I just want you to see, do you want to work hard, pay your loan down by $5,200, but do you want to give the bank $21,000 in interest to do it?
Not at all.
Okay, now I know what you wanted to say, but I'm glad you said what you said. Because I mean, we got kids out here.
Yeah.
All right. So let me ask you. So if you know you were supposed to pay $5,199 in 1 year, do you have to pay it in 12 monthly installments?
No.
If you had it, could you give it to the bank on line 1?
Yes.
They would have to subtract that from what you owe, wouldn't they?
Yeah.
From what you owe, if you subtract 5,100, listen, for folks that don't really believe me, I'm going to put $386,000 in my calculator. Okay. I'm going to put that on the screen. Got to bring this over where people can see it. Okay. So we're going to put $386,000 in the calculator, and we're going to subtract exactly subtract exactly $5,199.82. Okay. And that equals $380,800.18. Exactly what we have here on line 12. So, folks, you can choose how you give that money to the bank. You can choose to give it to them according to their own timing and give them $1,700 each month, or you can figure out what to pay so you can skip some of these interest payments. But I'm just picking this number out of the air, okay? $5,199.82. So if we pay that all at once, we're paid down to line 12 in just 1 month. What happens to all the interest payments between line 2 and line 12, folks?
They're gone.
They're gone. You just saved $19,352.85 in interest you did not have to pay. See, here's what we're talking about. You're gaining equity, $5,000 worth of equity in 1 year. $5,000 in equity in 1 year, but it costs $21,100 to get it. That's what hasn't been pointed out to us before. I got the equity, but it cost me 21 grand to get it. Now I can get the same amount of equity, but I don't have to pay $21,000 for it. I can pay $1,769.17 for it, the amount of interest I would pay on line 1. How about that? Has anybody ever pointed that out to you in life?
No.
How you feel about this right now?
From what you're telling me, I'm feeling good about it.
Okay. Do you have anything to ask or to add to this before I tell you why this is better than 2.99?
The only thing, all right, so instead of paying, like, say, first, make the additional monthly payment, then in the middle of the month, and pay the 4 and change, whatever. What if I was to double up on that? That still knocks it down faster, right?
Actually, when people pay that like a biweekly payment, all of my clients end their biweekly payments.
Okay.
No, you don't need to. Because the thing is, you want to pay the right amount of money for you in the right month. We're not even going to pay extra every single month.
Okay.
Only at strategic times during the year. And I give you an
So that is a question.
Yes, ma'am.
Go ahead. I'm sorry.
Go ahead. What's
All
your
right,
question?
So you see how you said that if we paid the $5,199.82, within the first month, and we come out saving over, $20,000 in interest. So every year, so like on that second year, would we have to pay $10,692, and then the third year, it's 15,000 or so, depending on what the calculator is?
There you go. See, here's what we're talking about. We're going to look at your particular budget and figure out how much you would pay. This is why I'm telling people, by watching these videos, they think that this is going to be good advice for everybody. No.
Gotcha.
We just want to find out how much Lolita and Barry have left over each month. The program is going to ask you to put that into your savings account. And then at the right time, the program is going to read your savings account, says, okay, here's how much we have in savings because you told us. For Lolita and Barry, now in month 3 or month 4, whatever, let's take some of that money out of savings and apply it to the debt so you can save the most amount per dollar. Now, what does that mean? Let me show you what that means. Okay. So, do you have a calculator handy?
Yes.
Okay. So we're going to show you on a calculator what this means. So if we prepay the $5,199, if we prepay that, we're going to knock off 12 payments and save a lot of money, correct?
Yes.
Let's say we have plenty of money in the bank, and you mentioned, because you're getting ahead of the game here. What if we prepay line 24, the $10,692? Okay, so if you have plenty of money in the bank, which one would you choose? Prepay line 12 or prepay line 24?
And logistically, line 24, it seems like that's what you would do.
It seems like that. So let's take a look at it. Remember, now we're going to get down to the nitty gritty. Okay. Now we're going to get down to the nitty gritty. Let me ask you a quick question. Do you guys like grapes?
Yes.
If grapes are $10 a pound this week, are you buying grapes?
No.
No.
We will not.
You are not. Okay. No matter how much you like them, because you're
Correct.
paying attention to how much you're paying, how much you're getting per dollar. How many grapes am I getting per dollar? I can get like 5 grapes for $1.
Right.
Okay. I'm not doing that.
Right.
So when we put our money down, you want to know how much interest you're saving per dollar. Does that make sense?
Yeah.
Let's take the $21,000. Let's put that in your calculator. $21,100.22. And we're going to divide that by the amount of principal we could pay on line 12. Okay. So we're on line 12. So we're going to divide that by $5,199.82. It comes to $4.05. So we just found out for every dollar I put on here, I can save $4.05 in interest. Wow. What if I only had $1? Would it be worth it just to put the $1 extra?
Yes.
Well, yes. Well, let me ask it this way. If you gave me $1 and I gave you back $4.05, how many times would you all do that?
As many times as you like.
Okay. The bank has to do the same thing. So it doesn't matter if you have $1 or $4 or $400. You want to know how much interest I'm saving every time I give you guys $1.
Okay.
You got it?
Okay.
So now let's do line 12. So we're at $4.05. All right. Let's do line 24. Okay. So we're going to do the 41,000. I'm going to clear this out. We're going to do the 41,907.12. We're going to divide that by 10,692. Okay. 0.96. All right. So, I go from $4.05 for every dollar down to $3.91. So if I can save $4.05 per dollar, should I ever accept $3.91 per dollar?
No.
So it matters how much you pay and when you pay it, doesn't it?
Okay.
You know how I really know that you don't want to accept less? You know how I really know? Because if there are 2 gas stations on a corner that you like and you need gas, which gas station are you going to if there are 2 gas stations on the corner?
The one that even just saves me 2 cents less.
I love that. Even if it saves you 2 cents. So listen, we need to have the same type of attitude towards our mortgages and our student loans and our credit cards and our car loans. If only somebody else would do the math for us. Folks, does this make sense to you?
It's mind blowing, yes.
Wow. Listen, I want you to know that you can know the month, day, and year you could be debt free. I've got another example. I want to get into this. So we've got another person on the stage. We're going to come back. We're going to get to you in just a second, but I need you all to know this. I'm going to go into why this loan is better than 2.99%. But there's somebody that we've been working with for a while. His name is Eric Thomas, the hip hop preacher. We got a brand new commercial out, and I want you to see what Eric Thomas has to say about this program. Watch our new commercial here. My name is Don Daniel, founder of P.I.L.L Method International, and our team created the most powerful money management, wealth building, debt elimination system ever created. At our recent seminar in Nashville, Tennessee, the keynote speech was delivered by the #1 motivational speaker in the world, Dr. Eric Thomas. E.T., as he's also known, mentioned he paid off his mortgage in 4 years using the P.I.L.L method. I invite you to watch and listen.
Listen to me, y'all. But one of his mentees took us through one of their programs, and I paid off my mortgage. But guess what happened? My marriage went to a whole nother level. And you know why? Because my wife is a security freak. And even when I blew up, my wife would be like, oh, you blew up, but how long is you gonna keep making this kind of money? I was like, I don't know, forever. She's like, you sure? Because I'm gonna keep my license as a nurse just in case you don't. So when I paid the house off, my boy was like, you ain't gotta do that, you can do this. But when I paid the house off using that program, it took the stress level all the way down for my wife because we no longer had a mortgage. Does that make sense? That thing that was coming every month, that was getting on her nerves, we didn't have that no more. And so she was at rest.
Did you hear that? No mortgage, no stress. If you would like to become debt and mortgage free within an average of 7 to 9 years by cutting your interest costs by up to 75%, go to pillmethod.com and request a savings and earnings report today. All right, ladies and gentlemen. So if you want like your savings and earnings report, you can go to pillmethod.com. You can go to pillmethod.com. You can also go and get more of our information if you will go to ice10k.com and click on the button that says get a savings and earnings report. You can know the month, day, and year you could be debt free within a 7 to 9 year window without refinancing, without needing to earn more money, and without sacrificing lifestyle. You can learn how to lower your interest cost. And therefore, we're going to show you how you can dictate your own interest rate, even though they're trying to charge you at 5.5%. We're going to get you down to like 1% or less. All right, everybody. So now let's get into this thing. I'm going to show you now what's going on here if we have the same mortgage at 2%. So I'm going to put it at 2.99. All right. And we're going to take a look at the payment here. And the payment is going to be, $1,625.31 as opposed to, okay, let me see here. It's our mortgage is $386,000. Okay, they left the stage. Okay, $386,000, folks, $386,000. All right, and let's see, we had that at 5.5. We're going to duplicate that. We also have that at 5.5. All right, there we go. Look at this. All right. 5.5 is $2,119.67. We showed here where if we did $5,199.82, if we prepaid that, we would knock out 12 payments and save a ton of interest. So what if we had Miss Lolita, what if we had our interest rate down to 2.99? The one that we missed.
So
go ahead.
It seems like it would be better, right?
Well, it does, but look at our payment. It's $1,625. Ooh, that looks better, doesn't it?
It does.
Instead of 2191.67. All right. So let's go back and let's take a look now at 2.99. Let's take a look at how much interest the bank wants. $199,111.60. That's over 30 years, though. Okay, 199 as opposed to 403,000. Oh man, that 2.99 is looking quite choice right about now, right?
Yes.
Okay, let's get down into the payments where the payments matter. Remember, interest payments you skip what?
Don't matter
Because now these interest payments of the 5.5, they're $1,700. But in the other, we're at 2.99. Look at there. They're only $961. But look at the principal payment. At 2.99, my principal payments are over $660,000. At 5.5, look at my principal payment. $424. So if I want to get rid of one line off this schedule, if I make my first payment and I want to get rid of line 2, I only have to come up with $424.44 at the higher interest rate. But at the lower interest rate, oh, why are you laughing? Why are you laughing, Miss Lolita?
So then you would have to do the same thing with $200 additional dollars on the lower interest rate.
Yes. Why do you think they lower the interest rate? To save you money?
Wow.
So a higher interest rate is better?
Yeah,
Listen,
the higher interest rate is better because we pay less and we still pay off, more money.
wow. So take a look at this. Remember that $5,000 we're going to knock off 12 months worth of payments? How much does $5,000 knock off of this lower interest rate?
It's less than 10 payments. Wow.
Yeah. How about that? Anybody ever point that out to you?
Never.
How come everybody is saying, here's the advice that I hear right now. I mean, on national TV, they're saying when the interest rates go down, what can you do?
Refinance.
And that's going to save you money, right?
Yes.
Well,
no.
She said, yeah, no. So folks, why are all the financial experts all across the planet, not just in the US, I'm talking about in the UK, I'm talking about in the Caribbean, I'm talking about in South America, I'm talking about all the places that we're doing business right now, they're getting the same advice. When the interest rates go down, refinance to the lower interest rate. And have you all ever rented, Miss Lolita?
Yes.
Have they, on the time that you were renting, have they ever lowered the interest, lowered the rent for you?
No.
No? They never lower the rent?
Never.
Then are landlords smarter than bankers?
I doubt it.
Because landlords always raise the rent.
Yes.
Bankers come to you every 5 to 7 years, say, let's lower your payments.
Yes.
Come on. When are we going to catch up? If you're saving money by refinancing or doing any of these things, if you're saving money, who would have to be losing money?
The bank.
If the landlords aren't losing money, why would the banks want to lose money?
They wouldn't.
They wouldn't. So by lowering your interest rate, you actually make it harder to pay off your loans. Are you prepared to tell that to your family and friends?
No.
No. Yeah, I know you don't want to tell them. But listen, point them to this video. Let me tell them.
Yeah, exactly. Because nobody would believe this.
Nobody would believe it. Come on. This is what we're talking about, folks. I want to thank you all for coming to the stage. Miss Lolita, listen, do you have any other questions for us? Are you complete?
I'm complete. We'll be going to the link. Do we need to have it first before we complete the?
Oh, well, let me ask you this. When is the best time to start saving money?
Today.
Okay. There's your answer.
Okay. Thank you so much. I really appreciate it.
You
know what I love, Don?
Come on, Rose. What do you love?
The fact that we have both husband and wife on the call at the same time, getting this knowledge at the same time, because if she had to have regurgitated this information to her husband, Barry, he wouldn't have gotten it. Like, he would have been like, what are you talking about? And you know what?
At all.
Right, at all. Because you got to be able to regurgitate. You have to be able to explain it the way Don explained it. And if you're a visual person like myself, I have to see it to understand it, to fully process it. You remember my sister that came on stage, Don?
Yes.
That, you know what she did?
What?
So because she was the only one on the stage, her husband wasn't there to see the information. She tried regurgitating it. He didn't understand it. He didn't believe her. They ended up refinancing their home, pulling money out. So instead of owing 220, they now owe 280. They paid off the vehicle using the money. So they put the car, the car that they owe in the mortgage, because if you think about it, you basically transferred one debt to consolidate all, and now they have a higher payment. And still the husband is not on this call to understand how to pay off the mortgage. Because they went and got a lower interest rate, extended another 30 years, and also added the car note and the debt all together. So I wanted to share that. I was just like, oh my God. If he just got, and she was like, he didn't want to get on. He didn't want to listen. And I'm like, oh my gosh, how do we get both husband and wife on the call at the same time to
Listen,
get this information?
Listen, folks.
Now that's funny though. You said that because I was actually walking out the room, but I'm a, I guess the best way to say it, I'm a money person. So we talking money, it brought my attention back. So I came and sat down with her.
See, that was wise. That was wise. Folks, listen,
Yeah.
will you share this out here? Listen to Credit Goddess. Share this information out here. Go ahead and share the room. Share the room. We got to 24. Let's get to 30 shares. Let's get to 30 shares. We've got 57 people in here. We got 27 people, at least 27 people online watching this information. Nobody else is giving out this game. Nobody else is giving out this game. So what we're going to do now, Credit Goddess, can we show, I think this is important. I want to come back to you. I want to come back and put some of those numbers in after we get Miss Jamila, her info, and talk to her a little bit. And I want to put the numbers for the car loan and the refinance into the amortization schedule so I can show people what happens when you do that. Miss Jamila, how are you?
I'm wonderful. How are you?
I am doing well. Thank you so very much for being here today. Do you have a question or comment for us today?
Oh, no, I was just brought on stage. I was one of the people who is closing on a new home build at the end of this month or sooner.
Okay. Did we give us some information that could be helpful to you?
Oh, yes, absolutely. This is, but I'm always the person that, ask more, it's more than just this mortgage that you want me to pay. So I've been on top of my realtor and them to provide these answers, but obviously they're not going to. They just give you, here's what your interest rate is and all that. So I've been hopping around Clubhouse and other areas. Also because I own an investment company with 15 other owners. So just trying to learn more about my own personal, how to handle it, as well as how to get into investing on a higher scale in real estate. So this was absolutely amazing information.
Wow. Listen, what we do for real estate investors is amazing. Because you guys do all kinds of math to make sure that you're going to cash flow correctly. I'm learning terms like ARV, after repair value, cap rate, all those kinds of things. I'm learning all that stuff. All right. Because I didn't know all of this thing. But here's what we're going to add to what you're doing. Okay. Interest cost versus interest rate. How can we lower our interest cost and still invest? When you get your rents in, we want you to invest all the monies that you intend to invest out of those rents. I'm going to show you what to do with what's left over to increase your equity at 5 times the regular rate so you can cash out refi about 10 years sooner and pay a lot less interest. And so now you can buy more doors with the money you formerly gave to the bank in interest. How would you like that?
I am all ears.
That's what we're talking about also. All right, so hang in there. Maybe I'll get a chance to, before we get out of here, I can go back and do some information on real estate investing. But we got Greer here. Greer, what's going on?
Greetings. Thank you so much for allowing me to get on the platform. My grandmother had a monthly payment of about $750 monthly, up until I would say about March this year. She started complaining about um, they're saying that her bill hasn't been paid. I'm like, what are you talking about, Gran? We sent out your payments. And I started noticing that they were returning our payments because it was made twice monthly, the first and the 15th of the month. Um, they were sending the payments back. So I got on the phone, and in speaking to them, it sounds as though they didn't want to say that it was an arm, but based on what they were actually expressing, I recognized that the payments went up by $400. He dilly dallied and pretty much didn't give me an answer to say, well, you have an adjustable rate mortgage. He didn't say that. But when you're telling me that I'm paying 1,100 thereabout versus the 750 or 1150, I'm like, something's wrong. Um, so that's where we're at. So all of our payments since March have been up and down because they didn't take our payments. They've just been sending it back monthly.
Okay. Are you caught up now?
We're not. We just, they sent it all back. They've
Okay.
sent every last thing back.
Okay. So with the monies, do you still have that money?
We still have that money.
Okay. Here's what you want to do. Find out how, because if you're not careful, the bank is going to grab all of your equity out of that house.
Okay.
Okay. You're in pre-foreclosure right now.
Okay.
So don't let them foreclose on you. Find out how much that would bring it current and give them the money.
Okay.
And we'll work out the rest, and we can work out the rest. So there are a couple of things that could have happened. You're right. The interest rate could have adjusted. All right. Or the taxes and insurance could have increased, which will also increase the payments. Are your taxes and insurance in the payment?
No, they're paid separately.
They're paid separately. So yeah, then it was an arm. Okay. But don't worry. Okay. Listen, get caught up, and I'll show you how to make the best out of that higher interest rate. In fact, they just did you a favor.
Okay.
Okay. So get caught up and let us know what to do. So you can hit me up on the back channel. Go to ice10k.com and get a savings and earnings report. Put all your information in, and then get a consultation, and we'll go over all of the numbers, and so we can show you how to make the best out of this situation. Okay.
Okay.
In fact, I like arms. I don't care if the interest rate goes up. I just care about how much interest I actually pay.
Okay.
Okay.
Yeah, got it.
All right. So have you been in here for a while? Have you been listening?
I have been listening for the last 2 hours. I'm pretty new to Clubhouse,
yes.
But I've been hooked to listening to you whenever it is that I actually recognize that you're on, and I'm like, so this is my fourth time listening to your call, and I'm sitting with one of my sisters who, she's a CPA, so for her it's like some of the things you're saying is new as well.
Yes.
So I'm like, I didn't understand. I still didn't understand certain things as far as how I get that, like the interest rate being higher. I didn't understand how can you possibly be paying less when the interest is higher. But I'm trying to get it into my blood.
Well, listen, you keep, because this was great about what Kurt was saying earlier, is that once we put this on there, it's up forever. You know what? You could listen. I hope neither one of you are teachers. Are you or your sister a teacher? Are you teachers?
I am not.
Okay.
Well, she's not either.
Okay, good. Because I was getting ready to feel sorry for you, because when a teacher learns this, oh my gosh, they just got to teach everybody. They can't sleep. Okay.
No, but I was a little nervous about paying it at the rate that they were saying, that the 1,100, because I figured that then I would be acquiescing in the last payment rate for what they're now saying is owed monthly. So I was a little bit gun shy about that. So I was trying to seek other options as to how to remedy the situation, because I'm like, doesn't that, once you actually pay what they're asking, now I'm basically saying I agree to this new contract.
Well, you listen, if you do not, they're coming to get that house.
No, I understand that one.
Trust me on that. Let me tell you how strong the contract is on that. Okay, because you find out how strong it is. we're going to, if you can miss 3 payments, you go into pre-foreclosure. That's how strong the contract is. Okay.
Right.
The contract is just as strong when it says that you have the right to prepay this mortgage. And when you do, there is no prepayment cost. And every single dime you prepay goes to principal. None of that money goes to interest. The contract is just as strong. And we're going to show you how to pay that loan off years sooner with your current budget.
Okay.
Sound good?
Got it. Yes.
All right. So listen, we're going to get back into this. Do you have any other questions for me?
No, I think you answered it. I appreciate you.
All right, folks, we got some new people in the room. Do we have any other questions in the?
Yes, we do.
Go ahead, Miss Donna, and then I got some on. We got some online as well.
Okay. And you needed me for something, Don.
Oh, that's right. Right. Hold on, Miss Donna, Credit Goddess. I want to make sure we get this in here right quick. All right. So tell me the new loan. All right. The new loan now that you were telling me about how much is it?
Which one?
The one that we used to refinance, the refinance you were telling me about.
Your sister.
Yeah.
Oh.
Do you have any idea how much that is?
It's $280,000.
$280,000. Do you know what the new low interest rate is?
I believe she said it was like 3.5.
3.5. Okay. So now, do you know how much money they rolled into the loan?
No, I don't know how much money they rolled into it.
Okay.
Meaning like the previous.
Yeah,
one?
you said they cashed out. How much was the car?
I know she had about less than 200,000 left.
Mm-hmm.
Or something like that. Or no. Out of the 220, I think she already paid off 11,000, but in interest they paid 36,000.
Okay. All right, but now they're at 280.
280.
Okay. So let me just pick out some numbers. So if you were to guess how much the car was that they paid off, about, if you were just to take a guess.
Her Sorrento, she probably had about 15,000.
Okay, let's take a look at that. All right. So now we put the $15,000 into this thing, right? And we're looking at the 3.5%. So here's what I need you all to see here. Okay. To pay off the first $15,000, let's say the car that they rolled into this loan is $15,000. Look at the cumulative principal here. If you're new to the room and you want to see this, why we don't roll in stuff into the mortgage thinking it's at 3.5% when it really is not. Okay. It's more like 52%. So let's take a look at this. If you want to see it, go to ice10kvideos.com, ice10kvideos.com. And we're going to show you what happens when you roll stuff into the mortgage, thinking you're saving money. All right. So now, ice10kvideos.com, go to YouTube and go ahead and subscribe. So in the first year on this mortgage, we're paying it down by $5,373. So remember, if you pay down your loan mortgage, we added in at least $15,000. We just added that in. So you got to pay off that $15,000 to get back down to where you were, right? So, so in the first year, you're paying off $5,000 of that, $5,300 of it. The amount of interest that you paid on that $5,000 you borrowed is $9,714 already. In year 2, you've just paid off $10,900 of the car. You're up to $19,000 interest on $10,000 borrowed. Once you pay off $15,000, there you are. We're at line 33. It takes 33 months to pay off the $15,000 at a supposed 3.5%, because that's why we rolled it in. But look at the amount of interest We just paid. There is no way on God's green earth they would have paid $26,000 on this car loan the way it was structured before. They would have paid like $1,000, between $1,200 and $1,500 interest on this loan as it was as a car loan, but they've just paid they're going to pay $26,000 rolling it into the mortgage. Folks, that is nearly 200%. When you pay back the first $15,000 and $15,000 interest, that's 100%. Add another $15,000, that would be 200%. So we're slightly under $30,000 interest here on $15,000 loan in just 33 months. This is how banks get people with perfect credit to pay 150 to 200% interest on loans.
Oh, when you just said that, Don, it hit me. It's like I teach clients how to improve their credit so they can get the best rate and the best term. And the reason why is because on their credit report, it shows that they are more than likely to pay off a debt. And they put so much work into maintaining it and improving it, right? That they're more likely to pay off a debt. So it's almost like a trap.
Yes.
To the people with good credit.
Yes.
Because they know they're going to get their money.
That's exactly right.
Oh my God.
That's what we've been trying to say. People with perfect credit, they pay more interest, not less.
When you're looking at it from the back end, because we know, because you're actually explaining what goes on behind the smoke and mirrors. And the people with the good credit are looking at it from the front end, which is how much, they can afford on the front end, like as far as monthly payments. Yes, a lower interest rate does warrant you a lower payment than someone with bad credit. But on the back end, where you guys don't know what's going on, you're paying more on the back end. And I'm glad that you actually put it. Listen, we got 29 shares in this room. We need to get more. Listen, and I'm a credit person, and you blow my mind every time you speak. And it's like, this has to be a crusade. This has to be a movement. We need to get more people listening to this. If you guys are not sharing this room, share this room so that way you don't have to regurgitate this information. But this will save a lot of people money, a lot of people time, and be able to purchase a home, more than one homes in their lifetime, if we understand this math. And use and utilize the bank for our benefit, not for their benefit, our benefit. If we understand how to play this game and beat them in their own game. This is mind-blowing. Go ahead, Don.
I am so glad Kurt set this up, because I got me a roadcaster now. I can do sound effects. Credit goddess, thank you so much for that. But we're not done with this example. We got just a little bit more, because this refinance was cost between $8,000 and $10,000 as well. So if we add another $10,000 onto that, that is $25,000 that has to be paid off to get back down to the original loan amount. If we take it down to $25,000, that takes 53 months to get it done, and $41,000 in interest. There you go. There you go. Okay, there it is, folks. So we got G on the stage. G, what's happening, man?
Good morning. Good morning.
How are you, sir?
I'm doing well. So I came into the room a little late this morning, but I heard you say that the lower interest rate cost you more money.
Yes, sir.
I don't know if that was in a specific scenario, but I refied my home, I think twice now. I went from a 3.5, that was the original loan, up to a 3.75. I pulled out about 180K, and then the interest rate dropped and I went down to a 3.25 and then down to a 2.75. The last refi was, it was a short duration. So the institution just said, we'll just have you sign 2 documents. We'll just lower your rate, because they didn't want to lose my business. I didn't have to go through a full refi. It was just a loan modification or rate modification or adjustment is what they call it.
Recast.
But now I'm down at 2.75. My payment now is slightly higher than the first payment, slightly. But like I said before, I pulled out 180K. I didn't use that 180K to pay down debt. At the time, I was thinking I was going to pull out money, invest into another property. I never did. I rolled that money into the market, and I've made more than 5% annually on that money since then. So I'm thinking my scenario is slightly different than the scenarios that you were referring to, but I'm kind of thinking like, how am I paying more when it feels like I'm paying way less and I've made more money on my money?
I'd be glad to talk to you about that. So here's what you did that a lot of people don't do, G. Taking money out to reinvest is a wise thing. Listen, sitting on that equity, does that make sense to you?
It doesn't.
It doesn't. So
it doesn't do anything.
So you pulled it out. Okay. So here's what I'm talking about. Refining just to get a lower interest rate, mistake. Okay. But if you refi to pull out money to get the to reinvest, and then let's say you didn't know what we're talking about here, and they gave you a lower interest rate. Well, that's another story. But what I'm saying is that what if you knew what I was talking about and you refied and you got that 180K out, and they said, you know what? We're going to lower your interest rate. What if you told them, nah, just leave me at the same interest rate? Let me tell you why. Let me tell you why you want to know exactly for you. Now, this is not across the board. This is individual. You can find out what is the right interest rate for you. But can I share with you just some basics here? Okay, G?
Sure.
Can you see my screen? Can you see what we're putting up here? Because if you go to if you can actually see this live on YouTube.
Hold on, let me pull it up on my iPad.
All right, great. So you want to go to ice10kvideos.com and you can pull it up on your iPad. But don't forget to turn the volume down because we need to ask you some questions. All right, folks, listen. This is the fastest 2 hours on Clubhouse. We are winding down. So, Miss Donna, would you please turn off hand raising at this point? So, folks, we're going to be back on here on Wednesday. Come back here on Wednesday to get more of what we're talking about. Okay. And we're going to have a brand new subject on Wednesday, something controversial, something that is crazy, because there's some things that we're being told on national news to do that we shouldn't do. All right. And one of the things is like refinancing. And another thing that I heard is pay off your credit cards. Focus on your credit cards first, because the interest rate is 2 to 5 times more than your mortgage rate. The interest rate is 2 to 5 times more than your mortgage rate. Therefore, you should be focusing on your credit cards. All right. And I'm going to tell you, yes, the interest rate may be more, but the interest cost is actually less. I'm going to show you that on Wednesday. All right. And another person that believes that, Grant Cardone, you may have heard of him. He says he never pays credit card interest. I'm going to tell you why Grant Cardone, in fact, that's what I'm going to name it, why Grant Cardone should pay interest on his credit cards. Why Grant Cardone should pay interest on his credit cards. And I'm going to show you why you should focus where you need to focus. So let me get back to G. G, can you see what we're talking about yet?
Yeah, I can see.
Okay, great. So give me an example of a loan at a higher interest rate, and then I'll show you what happens when you lower it. Give me the numbers.
So let's do a loan at 400,000.
Okay, 400,000 at 30 years.
Yeah.
Okay, and what's the interest rate?
Let's go with 3.75.
This is your higher interest rate, right?
Yes.
3.75. All right. And this is the principal and interest payment on this. Principal and interest payment on this is $1,852.46. Now, let's take we're going to take the same amount, okay, just to make it easy. All right. We're going to take the same amount and put it in at a lower interest rate. What's our new lower interest rate, sir?
Let's go to 2.75.
2.75. Okay. So we take that payment out. Take it out. Delete that. And there we go. Now we're going to just compare. 2.75, we're at 1632.96. All right. 1632.96. And at 3.75, we're at 1852.46. Okay. So far, the 2.75 seems to be winning. We're going to take a look at the summary on this. On the $400,000 loan at the 2.75 over 30 years, the bank wants $187,865. Now, here's another thing that you need to focus on. The banks are contrasting two 30-year loans. If I'm contrasting two 30-year loans, if I'm going to pay every single payment for 30 years, I want the lowest interest rate possible. Okay. But what if I want to accelerate? What if I want to pay fewer payments? What if I want to pay less interest, gain equity faster? Then all the numbers that the bank has given me, we have to throw out of the window, because if I can pay off in 7 years, these 30-year numbers don't apply. All right. So let's take a look at the other loan for 30 years. Ooh, $266,855. So let's take a look at this one first, G. So if I pay payment number one, and you can see how much goes to principal on payment number one, G.
Let's see. So your principal payment, the first payment is $602.
And the amount of interest?
$1,250.
So let's say we make that first payment in January. Okay. So our principal payment for February would be how much money?
It would be $604.
$604. So now if I prepay the $604, if I give that to the bank, now I've only got a few minutes left, so I'm rushing through this. If you want to see it from the beginning, it'll be up on YouTube. You can watch the whole thing from the beginning. But we can prepay that $604.34, couldn't we? We don't have to wait till February to give that to the bank, do we?
No, we don't.
If I prepay that, then the bank has to apply that to principal. I'm paid down to line 2 on my principal balance, where I owe $398,793.20, and my next mortgage payment for February is actually on line 3 of the schedule. Are you seeing that?
Yeah.
I just saved $1,248 in interest I don't have to pay. Pretty good?
Yep.
Okay. So, but when I lower, so this is at 3.75, I can get rid of one line for $604. When I lower the interest rate to 2.75, what happens to my principal payment now?
Let's see. It's a little bit of a delay. So when you lower your principal goes up to $717.
Exactly. When you lower the interest rate, your principal payment increases, your interest payment decreases. And so the key here is interest costs I skip don't matter. So even though the bank wants to charge me more interest per month, it's easier to skip out on the interest payments at a lower principal payment, which means a higher interest rate.
Got it.
Okay. So if you have, so figuring out, since you're a real estate investor, we want to do some math and say, how much money do I have to work with? And if I have a certain amount of money over a certain period of time and I can advance it to the loan without compromising monies that I want to invest in other properties, looking at my situation, which is the best interest rate for me? Now, you being a real estate investor, the right interest rate for you may not be the same interest rate for the real estate investor across town.
Got it.
We want to find out something that works for you and say, yeah, but I do know this. You absolutely do not want the lowest interest rate available. That's number one. And number two, you never want to have a mortgage that's less than 30 years. Take 30, take 40, take 50, but never take 20, 25, 15, 10, none of them. When you lower the interest rate, when you lower the term, you make it harder to pay the loan off early.
I definitely agree with that.
Okay. So that's kind of what we're going on. And watch some more of my videos, G. I wish I had more time to spend with you, but we got to let the folks go online in 2 hours. We could only stay on here for 2 hours. So is this the first time you come into the room?
I've come across your room, I think, once before.
Okay. So please follow the room. Please follow us on Clubhouse. Follow me. Click on my profile and follow follow the club and follow all of our moderators. And we're going to let the folks online go, but we're going to stay around just a little bit longer for the folks on Clubhouse. But I want to make sure that everybody understands how to get a savings and earnings report. Go to either pillmethod.com or ice10k.com and then click on get a savings and earnings report. Fill out all the information, follow the instructions, and you can know the month, day, and year you could be debt free. Here's what I need everybody to know, folks. Get this and get this well. We teach a lot of stuff here, but what we also need you to know, it needs to be individualized. You can save money with what I'm teaching you here, but without being individualized, you can't optimize your interest savings. You want to save the most you can per dollar. You want to do what E.T. did. Eric Thomas, the hip hop preacher, paid off all of his debt in about 4 years following the P.I.L.L method. And I want to say goodbye to everyone here. We're going to be saying goodbye to everyone that we're live streaming to with our last words from Eric Thomas. But if you're on Clubhouse, hang out. We're going to be right back. My name is Don Daniel, founder of P.I.L.L Method International, and our team created the most powerful money management, wealth building, debt elimination system ever created. At our recent seminar in Nashville, Tennessee, the keynote speech was delivered by the #1 motivational speaker in the world, Dr. Eric Thomas. E.T., as he's also known, mentioned he paid off his mortgage in 4 years using the P.I.L.L Method. I invite you to watch and listen.
Listen to me, y'all. One of his mentees took us through one of their programs, and I paid off my mortgage. But guess what happened? My marriage went to a whole nother level. And you know why? Because my wife is a security freak. And even when I blew up, my wife would be like, oh, you blew up, but how long is you gonna keep making this kind of money? I was like, I don't know, forever. She's like, you sure? Because I'm gonna keep my license as a nurse just in case you don't. So when I paid the house off, my boy was like, you ain't gotta do that, you can do this. But when I paid the house off using that program, it took the stress level all the way down for my wife because we no longer had a mortgage. Does that make sense? That thing that was coming every month, that was getting on her nerves, we didn't have that no more. And so she was at rest.
Did you hear that? No mortgage, no stress. If you would like to become debt and mortgage free within an average of 7 to 9 years by cutting your interest costs by up to 75%, go to pillmethod.com and request a savings and earnings report today.